Good. Okay. Let's talk about exits, or in other words, the sale of your business. How do you create one? How do you get the most value? What are best practices? My goal is that when you leave today, that you have specific, actionable steps on how to sell your business for the best value to the best buyer. And if you're thinking about buying a business, you can still reverse most of these best practices into best practices of buying a business. So you can take it from either way. We're going to talk about, so when I say a strategic, just a definition, when I say a strategic buyer is somebody who's in your industry who's not, so there's financial buyer and a strategic buyer. Financial buyer is just interested in cash flow. They're not usually the buyer that will pay the most amount of money because there's not a lot of synergies to be had between their business and yours, and the people who are going to buy your business for the highest price are the ones that have synergies. So a financial buyer is great. Nothing wrong with a financial buyer for your business. Strategic buyer is somebody in your industry who gets synergies, who's going to pay more than a financial buyer. So when I say a strategic buyer, for example, that's like, that's Google buying the next AI, AI software. Google will be the best buyer for that as opposed to a financial buyer who's just going to pay for the cash flow. So strategic buyer, highest price. We're going to talk a little bit about due diligence and negotiation. How do you actually go through the process of selling your business? What does that mean? What are best practices? How does that affect you? What do you do? We'll talk a little bit about deal valuation and structure, and if we have time, we'll talk about the people, retention, the decision to sell, and the timing to sell. Because a lot of people ask, hey, I've got a good business. It's throwing off, $500,000, million, several $1 million of cash a year, $10 million of cash a year. Do I sell? Do I hold? What do I do? And the timing of a sale, or the timing of a purchase for that matter, is pretty key. So background, I've spent most of my career in mergers and acquisitions, investing, climate tech. I've led M&A transactions for 2 public companies. One's called Danaher, based in Washington, D.C., another one's Steel Partners in New York City. I've led and completed about 100 transactions worth over $3 billion as a strategic buyer. And so today's conversation is about the best practices that you can use every day when you think about buying or selling a business. I was part of the team that created the Danaher acquisition system, which was named one of the best in the country. I'm a former startup CEO myself, so I know what it's like to run a startup, a small business. I ran that business for a couple of years and then have an exit myself. I've been an angel investor, and I'm currently the managing partner of Exit Ventures. We are a kick-ass venture capital firm. If you want to know more, we systematically create exits for our portfolio companies, and we sell them to strategic buyers. So if that's interesting to you, we are actually fundraising. Talk to me afterwards. It's a very compelling value proposition based on $3 billion worth of experience in selling to strategics. So how do we find a strategic buyer? So you've got a business, it's been running for a while, it runs well, it's throwing off cash, and you're thinking, do I look in the buy, sell, biz, page 40 to find my buyer or not? What do I do? So ask yourself 3 questions. Number 1, who's in the market today? Who should be in the market today? And who is complementary? So these 3 questions are very powerful. They're simple, but they're very powerful in helping you determine who the right business buyer is. Who's in the market? If you're queen of wraps, right? Then you say, who is the largest wrap business in the Western United States or the U.S.? Right? Who's in the market today? Who wants to buy me because they know this business and they're bigger than I am and want that additional growth? Or who should be in the market? So who does billboards but doesn't do car wraps. So if you're in advertising and you're constantly doing billboards and you're doing all kinds of open market advertising, but you don't do wraps, well, you should. So who's not in wraps that should be? Advertising, billboards, et cetera, would be a really complementary business. And then who's complementary? So that would be, for example, if you've got the same customers as someone else, but you're not necessarily in the same business. So if you make screens for cars, and you are getting bought by a tier one automotive supplier, right? They don't necessarily make screens, but they're trying to combine all of these products to be able to sell into the same end user, the auto manufacturer, Honda, GM. And so who's looking for a product consolidation strategy where they're not competitive with you, they're not in their market, but where they can bundle your products and then sell more effectively in a vertical integration strategy to their customers. Let's make this interactive. So we've got Q&A at the end, but we can easily do Q&A as we go. And frankly, I kind of prefer the Q&A as we go because it just seems like this is more of a two-way conversation instead of a one-way conversation. So any questions on that as far as finding a strategic buyer? Any questions before we move on? Okay. So finding a strategic buyer is like dating. You don't just walk up to somebody and say, hey, buy my business, and have it done in a month, right? It's surprising how many times I talk to people where they're like, well, my business is amazing, and I just went up to these buyers, and I just thought that they'd be so interested because they should be, and why can't they buy my business in a couple of months? It's a long-term relationship building. So you need to think of the best practice is to think if you're going to sell your business, you need to start 2 to 3 years before you want to sell it to actually start the process. If there's one thing that you remember from this conversation today, start 2 to 3 years before you actually want to sell. Because you need to lay the groundwork, you need to lay the foundation, and frankly, you need to get your business ready to sell before you can't just walk up to somebody and say, hey, my business is great, just buy it, and expect the maximum or best price. Look for ways to cooperate. So if you can cooperate and build relationships, if you can get someone, for example, to sell one of your products, if you sell widgets and there's a much bigger company and your widgets are complementary to theirs, right? Say, look, sell my widget as part of your product portfolio. Let's work together. And what you want to do is you want to get them to rely on your product or software or service as much as you can for a year or two. Because if they sell it and they like it and their customers like it and their customers see your product is integral to their product offering, now you've got them. You've got them on the hook because they're like, my customer expects this from me and I don't own it, you do. So now we need to start thinking about an acquisition. Next thing, anticipate the roadmap of where the strategic buyer or potential buyer is going. So in technology, if you're talking about software, let's say we're talking about AI, AI software to like personal assistant AI software. There's a lot of people working on that. If you're thinking, I want to sell to Google, then it's not really relevant what you have today necessarily because they've already got the next generation of software in the pipeline. They've already spent $5 or $10 million on that software. And so if they bought you today, it doesn't fit into their pipeline necessarily. It might, but it probably won't. And so what you want to do is say, hey, where is Google going with this type of AI software, for example? Where are they going to be in 6 or 12 months from now? And how can I develop ahead of that curve? If I've got the world's greatest software, how do I anticipate that, get ahead of them, ahead of their technology development curve if I can, and then say, hey, look, you're here today, you're going to be here tomorrow, next year, let's say next year, and what I can do is my software can now help you with all of your development efforts from where you're going. It can save you money and accelerate your product development so that you can get here faster, cheaper, and easier, more effectively by buying me. That's one of the best ways to sell your business if you're in technology, is to anticipate the roadmap of where people are going and then help them get there faster, easier, cheaper by giving them your business on a platter. And then the last thing is everybody wants synergies. What are synergies? Synergies is where 1 + 1 = 3, right? 1 + 1 = 5. So say, for example, you have a great widget for whatever that is, right? You have GE come along and say, hey, if we could sell this widget through our sales channels globally, we would be able to increase your sales from $5 million a year to probably 20, because we have worldwide sales channels, right? We have customers already who are already in this market. And so for GE's like, I can buy this business that has $5 million in sales and $1 million of annual profits. And if I buy, let's just say, for example, I buy them for 5 times their net income, just as an example. I can buy this business for $5 million, and if I'm GE, I will make $10 million of cash flow in the first year because I'm putting them through my global sales channels, right? That's 1 + 1 = 5. That's what buyers are looking for. Sophisticated buyers are looking for those synergies. And so you want to find the strategic buyers who are looking for synergies because they will pay you more. In that case, if they'll try and buy you for $5 million, and once you realize that they're going to put your products through their global sales channels and they're going to go from 5 to 20 in the first year and probably 30 the next year, and on $30 million of revenue, they're going to make $6 million of EBITDA, cash flow, you're not going to sell your business for $5 million anymore if they're going to make $6 million of cash flow in the first year, right? Now you're going to sell it for $20, $25 million instead of 5. So that's the synergy. So your goal as a seller is to say, how do I find buyers that will get the most amount of synergies from what I'm doing? Because they will pay the most. Your job as a seller, your job as a buyer, those who stood up and said, I want to buy, is find out where you can get the most synergies and not pay for them. If you're the GE in that example and you can actually find someone to sell you for $5 million, you should do that all day long, right? So that's the synergies is the magic that make acquisitions happen, literally. If you know what you're doing, you only get into acquisitions if you can create some sort of synergies. Now, that's not always true. Queen of Wraps, that she bought a business and they didn't necessarily have synergies to begin with. She made it work out really well. Congratulations, right? It's just harder to do that. If you can buy a business where you've got synergies in the first year or two, you're so much better off because 1 + 1 = 3 or 4 or 5. Any questions on synergies, buying, how strategics think about synergies, anything like that? Yeah.
How do you anticipate the value of your solution as a seller to the buyer? Because they're not going to give you their financials, or you're not going to know how much they're going to take your solution that's going to multiply their business.
Yeah. So I have a first answer and then a skeptical answer. So first answer is when you get to know them, hopefully you're building a relationship. And as you build a relationship, a lot of buyers will say, look, you say, why are you, how do you see this fit, right? You ask open-ended questions after you've started to get to know them. And how do you see this fit? It's just like the relationship, right? You're dating and you're like, where do you see this relationship going here in the next 6 months? You ask that when you're dating, you ask that when you're dating a buyer. And sometimes they'll tell you, sometimes they'll be very close to the vest, but oftentimes they'll be like, look, you guys do great in the Western United States, we've got global sales channels. This could be a great fit for a global. They may not tell you their P&L, right? But they can say, look, you guys do great in the Western United States. You only sell in the Western United States. We've got global sales channels. And then you can kind of estimate, well, if I've got 5 million in the Western United States, I could do 10 or 12 in the US. I could probably do another 10 in Europe, and right? And then you can figure, because you're already in that business, you can figure that out. Somebody else who's a little bit more skeptical would probably say, take them out to dinner and get them drunk, but, I'm not gonna, I'm not gonna go there. So yeah, any other, yeah. A synergy that I've experienced? Sure. So I'll tell you my very first corporate venture capital deal. So my very first deal investing in a startup as a corporate investor. So this was 1999. I'm dating myself. I worked for a company called Danaher. One of the businesses that we owned was a business called Veeder-Root, which is the number 1 gas pump manufacturer in the world. They sell all of the gas pumps and now it's Veeder-Root, Gilbarco Veeder-Root, but back then it was just Veeder-Root. And so they make all of the gas pumps in your gas station. We were looking at a technology called vapor recovery system, which is the accordion-style rubber end on the end of your gas hose there when you fill up your tank. California was looking at regulating that in order to capture the fumes that came out of your fuel tank when you fill up your tank and pollute the air. And there's millions of tons of those fumes that go up into the air every year from everyone filling up their tanks. And so it was like this little $2 million revenue startup that had some really interesting technology. And not only does it not prevent the fumes from going up into the air, but it actually pumps them back into your tank. So instead of losing 2% of your gas through fumes, you get 2% of your gas back into your tank instead of losing it up in the air. And 2% for a big semi-truck company, that's a really big deal for a year for 50 or 100 different trucks. So we said, hey, you're $2 million in revenue. We're Veeder-Root. We sell half of the gas pumps across the Western United States. So let's talk. California is thinking about mandating your technology. They knew that. They said, if California mandates our technology, we're going to be worth a fortune. So instead of buying us for $2 or $3 or $4 million, because we're break even, have no profits whatsoever, but we have $2 million in revenue. So instead of us selling for $2 or $3 or $4 million, we want to sell for $8. Okay, good. We waited until California was obviously going to implement their technology. We bought them for $8, and that technology has probably created $150 million of value easily for Gilbarco Veeder-Root since we made the acquisition. And it's mandated by law in California, Oregon, Washington, New York, a lot of states, all over Europe. Mandated by law. I love it when my product is mandated by law. Thank you very much. Right? We bought them for $8 million, and just that addition, just the pure addition that they charged on top of the price for the pump has generated easily $150 million of incremental revenue at very high profit margins. And it saved about 100 million tons of gas fumes going up into the air. So you talk about synergies, that's the kind of synergies that these corporate buyers, this is what I'm talking about. This is what I'm talking about. You should sell your business to a strategic. This is what I'm talking about. This is the magic of selling your business to a strategic who has lots of synergies. And the buyer or the seller, they sold a business that had no cash flow at all for $8 million, and there were 2 owners. They made a lot of money, were very comfortable, and Danaher made a frickin' fortune. Okay, any other questions on synergies? Okay. if it's time to sell, there's a couple of things you got to think about. Number one, if you've never sold a business before, or even if you've just sold one, hire good help. It will be worth it. And no, I'm not pitching a law firm. I have no, no skin in the game here. But I have bought a lot of businesses from entrepreneurs who had the family lawyer who had no idea what he or she was doing. And I have to be careful how I say this. We were sophisticated buyers who knew what we needed to do in order to get the best possible deal, and the family lawyer had no frigging idea. And we got a really, really, really good deal, and the seller, unfortunately, who was not represented by people who knew what they were doing, did not. Period. It's not that we're trying to take advantage of anybody, but if we just say, hey, here's the most favorable contract that we can possibly imagine is our first bid in this conversation, and the family lawyer says, okay, great, I'll take that deal, right? So hire advisors, investment bankers, and lawyers who know what they're doing. They will get you better terms, they'll get you better price, they'll help you with process. They are worth the money that you will pay them. 99.9% of the time, hire someone who knows what they're talking about. Good process equals good outcome. That's one of my favorite sayings. So look for good process by hiring the right people. Before you sell, it's like your house. When you're selling your house, do you let people walk through your house with a disaster kitchen? The beds aren't made, it hasn't been vacuumed in 3 weeks, and there's dirty diapers, in the garbage? No. 2 years ago, maybe. Exactly. So you clean up your house before you let buyers walk through your house. Duh, it's obvious, right? You do the same thing with your business. You make sure that there's no open positions. There's your VP of sales, if it was an open position a few months ago, that person has now been hired. There's no outstanding litigation. That's a really big one. People will assume the worst case scenario. When they're buying your business, they will have to assume the worst case scenario for any big risk that exists in your business, because they're like, I'm not going to overpay. I cannot overpay, so therefore I'm going to assume the worst case. So if you don't hire the person, they're thinking, well, they can't hire the right person. So I'm not going to be able to hire the right person. So that means the VP of sales position is going to be really tough to fill. And you're thinking, oh, anybody can hire these guys are in my industry. They'll hire a VP of sales like this. And they're thinking, if they haven't done it yet, I'm not going to be able to do it. And what does that tell me about their business? Litigation, they're going to automatically assume the worst case scenario, maximum penalties. They're not going to assume the best case scenario and then have the worst case scenario happen. And again, overpay. So everyone's worrying about overpaying. So your job is to make your inside of the house immaculate before you let somebody take the tour. And then the last thing is other thing, recurring revenues and recurring profitability is the best and number one way to increase the value of your business. If you have recurring revenues, meaning under long-term contract, if you've got contracts that last 3, 4, 5 years, those contracts will be valued significantly higher than a contract that expires and is renewed every year, and significantly higher than just revenues that you get coming off the street every day. Buyers pay a premium for security. They hate uncertainty. So if you've got a 2, 3, 4, 5-year contract, you're golden, especially if it's really profitable. If you just rely on people coming in off the street, your revenues, even though you have 10, 20, 30, 50 million of revenues of kind of generated every quarter, it's not going to be valued nearly as well as long-term contracts and the stability of the earnings that are associated with those long-term contracts. So do what you can to even if people aren't under contracts now, get them under contract. Say, hey, look, how about if I give you a 5% rebate, 5% price reduction, if you sign a 3-year contract? That's totally worth it. You should do that every day of the week to give them just a little bit of a price reduction in order to get a 3-year certainty for a buyer because then the buyer will pay you, instead of paying you 2 or 3 or 4 times that revenue, they'll pay you 8, 6, 8 times. So you gave them 5% off, and you just got 2 times the contract value in return. So that's a trade you should make every day. And then the last thing is it's a very time-consuming process to sell your business or to buy a business. Either one. It's very time-consuming. If you do it right, it's going to take a lot of time and due diligence and negotiations. So get the business ready so that it's more or less on autopilot, so that you can focus on the really important thing of selling it or buying it, and that you don't kill yourself trying to run a very complicated business that needs you 50 or 60 hours a week and trying to sell it at the same time. Okay, so we don't have a lot of time, but I'm going to skip through some of this. A little bit of humor here. Sometimes people think the really small win is a really big deal. I want to try and focus you on what's the big deal. So, number 1, key takeaway, understand how the leverage shifts. If you're selling your business, at the very beginning, let's say you have 2, 3, 4 buyers, potential buyers that you're talking to. It's at the very beginning of the process. You have all of the leverage because you've got competition. And you can pick and choose any one of those buyers at any time, and you can tell the rest to go away. So you have all the leverage. The day before closing, if you've told 3 out of the 4 to go away, and you've negotiated a contract for 3 months, and you've done 3 months of due diligence, and you're exhausted, they're exhausted, everybody's exhausted, it's the day before closing, and then suddenly the buyer calls you up and says, we're not really sure about this. I'm going on vacation to Spain. I'll see you in a couple of weeks, and I'll decide then if I'm going to close the deal. Who's got the leverage? Right? You have no leverage the day before closing. You have 0 leverage the day before closing. So see how it went from you have all the leverage to you have 0 leverage the day before closing. So your job as the seller and your job as the buyer is to understand how that shifts as you go through the process and how to maximize your leverage as you go through. If you're a seller, you keep at least 2 buyers in the process all the way through up until, if you can, the day before closing. Because if you've got 2 guys involved the day before closing, you still have leverage. If you've got 1 buyer the day before closing, you have no leverage. Now, it's really hard to keep 2 guys in until the day before. But you keep 2 guys in, if you can, until a couple of weeks before closing. If you can keep 2 interested parties kind of neck and neck creating competition, then you just say, hey, look, in the negotiations, you say, well, you, buyer A, I don't like that term. Buyer B will give it to me, right? And so you put them against each other all the way through the process, and you come away with really good terms. That's the best way, is to create competition through that process. There are other best practices. We don't have time. The other thing is if you're a seller, you never, ever, ever give exclusivity until like the week before or 2 weeks before. Because as soon as you give exclusivity to a buyer, you lose all leverage. So don't do it. Or if you're a buyer, be like, hey, I want exclusivity, I'm going to do this deal and it's going to be great and all this kind of stuff. Here's my non-binding term sheet, except for the exclusivity clause, which is binding, and I want exclusivity for the next 3 to 6 months. If you can get that, you just took the knees out from underneath the seller, and you have massive negotiation leverage because you have exclusivity. They can't go talk to anybody else. So very, very important point in terms of how do you maintain leverage. Any questions? Yeah.
So if you're a seller and they want exclusivity, how do you protect yourself?
Say no. I mean, it's tough, right? It's tough. So you just say, look, the best way is if they keep demanding it, you say, we're willing to give you exclusivity as soon as we know that, one, you're serious, two, you've done all of your due diligence, three, you have all of the financing you need, and everything's, like when we have reasonable assurance that you're the buyer and you're going to come through, then we will give you exclusivity. But you don't give exclusivity too early, and you just tell them that. We can't give you exclusivity too early because we'd be cutting our throats. So make sure the contract is negotiated, the financing is in place, all the due diligence is done, and frankly, at that point, it's like 2 weeks. But say, we'll give you exclusivity, just not now. Hi, Kristen.
Do you walk away from a deal as a buyer when they won't give you exclusivity?
That depends on the dynamics and how bad people want to sell, how bad people want to buy, and what your other alternatives are. What are your options? If you're the buyer and people don't give you exclusivity, if you're smart and you know how to play your cards right, you can generally sense if other people are involved. And not that I would take them out and get them drunk, because I don't do that, but some people do. But you're going to see, like if you're not the only buyer and there's other people, they're going to be busy, right? Certain days, they're going to be like, oh, here's a bunch of data in the data room that you didn't request. Right? A lot of these analyses all of a sudden start popping up and you didn't ask for them, and they're like, someone else is asking for these. So there's another buyer involved. So these are really important kind of fine points of how do you feel out the situation, but when you kind of know what to look for, you're like, there's nobody here. They'll meet with me any day that I ask, and there's nothing in the data room that I didn't ask for. Good sign if you're a buyer. And then so then you can push exclusivity. If there's a whole bunch of competition and they tell you no to exclusivity, it's like, well, how bad do I want this? Because I may have to go without exclusivity. Yeah. Anything else? We're running out of time. So, yeah, I'm back. Same thing. Contracts with key suppliers. If you have advantageous terms with key suppliers that are key to you doing your job the way you do it, put them under contract, right? Or prices that are favorable or terms that are favorable that are key to you doing your job, then you want them under contract. If they're a commodity supplier, right? If they're selling you paper, yeah, who cares, right? Like, yeah, key supplier. You want to reduce uncertainty. That's what you're trying to do. You're ask yourself the question: what would the buyer want in this situation to reduce uncertainty? And that will always give you the right answer. Yeah.
We got one down here.
Thank you. But you can buy exclusivity. You can make agreement and put deposit and said, okay, we will do our due deal, and if all documents confirm, it's like everything okay. If right now you provide information and it's wrong, it's like you can buy it.
Yeah, I mean, money talks, right? Like if you want to put money down and look, if you're a seller and you say, look, you want exclusivity really bad, put down a $100,000 deposit, and then we'll negotiate like under what terms it's refundable and not. Like you say, like if everything is fine and you walk away anyway, I keep it. But if anything I've given you is incorrect, or if it's bad news and you walk away, well then, you take your money back. Me as a buyer, we never put money down, ever. Not once in 100 transactions. Because as soon as you put money down, it's really hard to get it back. But depending on negotiation, and frankly, I worked for a multi-billion-dollar public company, so we had a lot of leverage and people wanted to sell to us and we were strategic and all of that kind of stuff. So we didn't have to. Sometimes you might consider putting a deposit down, but I would put it down in an escrow with a third party. Never, ever, ever, ever put a deposit down with the other company because you will never get it back. But bank escrow, maybe, yeah.
Yeah, I feel like we're flowing here, so we're just going to keep on going. Okay, if we got really good questions. No, you're good. No, it's for a recording.
You talked about this, making sure that you start 2 to 3 years before, and then on your second slide, it talked about EBITDA strength. Can you correlate those together for people that are either selling or buying? Like, because I'm sure you've seen it a lot where it's 20,000, 20,000, 200,000, and nothing has changed. Would you mind tying that together for people to understand why you start that early?
Yeah, so the first comment was start early to build the relationship, just like you're dating, so that they get to know you and they're more likely to actually want to buy you. So that's number one. Two, in terms of earnings, like you said, if you decide that, oh, hey, you know what, I've kind of been a little bit lazy in my EBITDA, in the way that I go out and aggressively pursue high margin business, and so my EBITDA, meaning your cash flow, is been a little bit lazy and a little bit low, and all of a sudden you're like, hey, I'm going to sell my business. I'm going to do everything I can to get my EBITDA, my net income up. And then all of a sudden, as you say, it kind of jumps because now you're like laser focused on it. If a buyer sees, 1 million, 1 million, 1 million, 3 million, they're like, yeah, that's not necessarily a trend that I'm going to pay for in full because I don't know if that's sustainable or not because you've only done it 1 year. If you start this process of selling your business for 3 years before you actually want to or need to, and you're like, yeah, I can get my EBITDA from 1 million to 3 million if I do certain things, and you're done, and you do it, and you're successful. Let's say your EBITDA goes up to 3, and you keep it there for 2 to 3 years. Now the buyer has to pay you in full for that full $3 million because it's obviously recurring, sustainable, and they can't say, oh, well, you've had $3 million for only 3 years, so I'm not going to believe that it's sustainable. It's like, yeah, it is. It's 3 years, right? So does that answer your point, or was there another? Yeah. Okay.
Keep it going. Who else? Did it spark any other thoughts? No?
Anything in contracts? We can distribute this to anybody who's here today. We can distribute these slides if you want. But just a quick takeaway in terms of contract. You, as a buyer, you want, again, to mitigate your uncertainty, you want what's called representations and warranties in your contract, which is basically saying, as of the date of the contract, as of the date of the purchase, you're going to tell me and essentially guarantee that all of these things are actually true. It's a great way for you as a buyer to make sure that historical financials are actually what they say they are. Lack of litigation actually is a lack of litigation. Employees haven't told management that the day after closing they're all leaving, right? Like all of these things that would be a disaster if they were not true, you should absolutely, and a good lawyer will help you with this, say, look, as a buyer, I need a whole bunch of representations of warranties, not promises for future delivery, not promises on the forecast, but saying as of the date I buy this, things are in order. And I'm basing my purchase price on things being in order the day that I buy it. And if you as the seller can't give me that assurance that things are in order and you're not hiding things under the rug, I'm not going to pay this price. I'm going to pay something much lower, or I maybe don't even buy it at all. And as a seller, you should be totally willing, because hopefully you've been very truthful during the whole due diligence process, to say, yes, historical financials are true. Yes, lack of litigation really is true. Yes, there's no notifications from employees that they're all planning on leaving, et cetera, et cetera. You should be willing to do that to reduce uncertainty and to increase the purchase price of your business. Your lawyer and your banker will be able to help you with all of that. Be organized. Good first impressions are valuable. It will increase the value of your business. Good deal lawyers, good bankers, investment bankers are key to you getting the maximum purchase price. Anyway, the rest of these I can send these slides if you want. There is some valuation and structure points that we can talk about. HR issues if you want to talk a little bit after, I'm happy to keep talking or send you the slides. Thank you very much. Appreciate it.
Awesome.